In the lending industry, what makes people most preferable as customers is their ability to pay for the money they borrow. For people with good credit, the best lending rates are easily available when shopping for car loans. Auto loans for people with bad credit routinely come with higher interest rates if such loans come along at all. Having bad credit tends to make lenders uncomfortable, and the only logical course for them to take when financing someone with bad credit is to charge a higher interest rate due to the risk involved with the loan. To determine the creditworthiness of a borrower, the lender relies on the individual's credit score. A credit score is all of a loan applicant's credit activity boiled down to a single number from 300 to 850, with 300 being the worst possible score. The breakdown of the credit score does not follow a proportional standard, and what qualifies as good, average, or bad is based on certain economic trends and demographics based on millions of scores. How the value of a credit score is arrived at is based on a much less esoteric standard and is derived from 5 qualities that make up an individual borrower's financial history. Hard numbers that make up the score itself. Breaking down the credit score according to standards established by the Fair Isaac Corporation, or FICO, reveals at a glance whether someone is capable of meeting the obligations of the debt. Auto loans for people with bad credit begin with the credit score. The largest part of the FICO score is determined by a borrower's payment history. About 35% of the score is calculated on how well a borrower has paid his or her debts prior to applying for an auto loan. This includes everything made in a debt and repayment arrangement such as credit card bills, car payments, rent, utilities, etc. Payments made on time and in full have the greatest impact on a person's credit score, and someone with a low score is likely to have had trouble meeting previous debt obligations. This is the hallmark of bad credit, and people in this category will be thought of by lenders as having a greater risk of defaulting on auto loans. The second biggest piece of the FICO score, at 30%, is how much debt the individual has accumulated versus their ability to pay, or how much income they bring into the household. This is referred to as the debt-to-income ratio, and people who have a large amount of credit card or other debts while making an insufficient amount of income to meet those debts will quickly find themselves looking for their auto loans in bad credit territory. This is one of the most common ways people damage their credit, as they tend to put expenses better dealt with in cash on a card instead. To a smaller extent, just 15%, the amount of time an individual seeking auto loans has actually had to experience with credit makes up a part of the FICO score. This creates something of a paradox in negotiating for auto loans, since most younger consumers simply have not had enough time to accumulate any sort of credit-related reputation. Yet, this lack of credit history has the effect of lowering credit scores and places these people in bad credit turf right out of the gate. The way to counter this is for younger consumers to open credit accounts without going wild on the number of accounts they open. A few accounts are an indication that more than one lender thinks these consumers are worthy enough to be approved for a line of credit. The number of credit accounts an individual has can have a positive or negative effect on one's credit score, and accounts for 10% of the FICO score's makeup. There is no hard rule for how many accounts one should have, and it's a fairly easy trap for people with decent credit to fall into, to open too many accounts and push down their credit scores. Many consumers open credit accounts they don't need simply because an easy application comes in the mail, and without realizing it, push their credit scores down in the process. When lenders consider applications for auto loans for people with bad credit, they look at the borrower's credit activity based on what their credit scores indicate. A mass of credit accounts tend to worry lenders, and rejecting auto loan applications for this reason is fairly common. A further 10% of the FICO score is dependent upon the nature of an individual borrower's credit accounts. If there are a number of credit accounts established with different banks, they tend to have a positive effect on an individual's credit score. While it's not the biggest factor in how good or bad a credit score is, a certain amount of diversity in the credit accounts people hold can push them closer to securing an auto loan. Changing a credit score is in the hands of the consumer. While there is no quick fix, a little personal responsibility is the best way an individual can stay on top of his or her credit. Obtaining one's credit score is easy. the top credit reporting bureaus, TransUnion.com, Equifax.com, and Experian.com, make these credit scores available at a minimum cost and effort. Since all three are on the web, it's a simple matter of clicking a link and placing an order. Having a credit score in hand is the best way a consumer can maintain control of his or her credit reputation. Federal Auto Loan. Good credit, bad credit, no credit, all good.